Okay, good morning. We are back in business today. Learning Catalytics on Monday had a temporary, didn't work. They did an upgrade over the weekend, and that's what caused it to not work, but it's all fine now. So we're back to a normal class. We have a question in Learning Catalytics. We went over this material on Monday. When 100 shares of $1 par value common stock are issued at $25 per share, paid in capital in excess of par value, common stock will what? Well, par value always goes to common stock. So the dollar will always go in the common stock account. Anything above par value goes into this paid in capital account. So in this case, we sold it for 25, we issued it for 25, par value is $1, so that means $24 of every share will go into paid in capital in excess of par, so $24 a share times 100 shares is going to give us the 2,400 increase to paid in capital. Okay, so this first one, the answer is increase 2,400. I'm going to be leaving this question, it'll stay open a minute or two. So if you're just coming in late, you can still answer it. It will stay open on your device for a couple minutes. It will close. I'm not going to make an announcement. It'll close at some point in the next few minutes. So make sure there's your freebie for the day. It is increased 2,400. Okay, so what we're going to start out with is I just want to talk briefly. I went and got some real-life examples yesterday. So this is Kohl's. Kohl's is publicly held, and they issue a 10K. And in their stockholders' equity section for Kohl's, if you Google Kohl's Corporation 2014 10K, you should get a link that pops up, or you can go to Kohl's website. If you go to any company's website and look for investor relations, you'll be able to get their annual report. This is their annual filing with the SEC. It's called Form 10K. And I looked on the balance sheet because the balance sheet is where we're going to find stockholders' equity. So this is an excerpt from the balance sheet. And we see in stockholders' equity, the first thing they list is common stock. And it tells us 364 and 360 million shares issued. So they're telling us how many shares they issued. And the first number refers to February 2014. The second one refers to 2013. Paid in capital, so we know that in that common stock line, that's all the par value. Paid in capital is anything above par value. Their next line down, treasury stock, it tells us is that cost. And again, if we have treasury stock, whatever we buy it at is what it goes into. And treasury stock is listed as a negative because it reduces stockholders' equity. We can't own ourselves. And then it has accumulated other comprehensive loss, whatever that is. It's beyond the scope of our class. And then retained earnings. So that section of stockholders' equity looks very much like what we've been looking at. Then the notes to the financial statements are always interesting. If you download the financial statement in a PDF form, you can search for words. So I searched for treasury stock and this note popped up. It tells us we account for repurchases of common stock using the cost method. Okay, so they're saying they use the cost method, which is generally accepted accounting principles. And then in the very first note for the whole financial statements, you go to the end of the financial statements, you'll see the notes to the financial statements. The very first note talks about their business. It tells us that Kohl's operated 1,158 department stores and a website, and their stores are located in 49 states. And then it says our authorized capital stock consists of 800 million shares. So Kohl's has 800 million shares authorized. They've only issued 364 million. So they have this big, huge authorized number. Back when they created Kohl's, they picked that number. Now, it's possible to change that authorized number. Companies usually don't have to because they pick a huge number at the beginning. And then it tells us Kohl's has a 1 cent par value common stock. Okay, and then 10 million shares of 1 cent par value preferred stock. So that is their authorized stock. Now, so Kohl's told us they have authorized 800 million shares of common stock and 10 million shares of preferred stock. If we click back to their stockholders' equity section. It has common stock, paid-in capital, treasury stock, other loss, and retained earnings. Kohl's has no preferred stock. What that note was telling us is they are authorized to issue it if they ever wanted to, but they have not issued any at all. So it's interesting when you look at a financial statement, you should be able to look at the financial statement and start recognizing things on it like we've talked about here. Okay. And then one final note in their financial statement, it says we pre-purchased 15 million shares of our common stock in 2013 and 2012, and the timing of those purchases is based on their cash balance and the stock price, and then they have more shares they're going to be buying, and they're doing it for, I think I read that they're doing it so they have an employee, they give employees shares occasionally, so they need to repurchase their stock for that. Okay. So anyways, if you have occasion, if you're interested in a company, you should download their annual report and find the section in it with financial statements. Actually, usually on financial statements, I think it's section 7 or 8. So it'll be the financial statements. The annual report will actually be anywhere from 75 to 200 pages long, but the first page is an index. And typically the financial statements are item 7 or item 8. So you look down there, you click on the hyperlink, and then you go to the financial statements. So you'll see financial statements, you'll see the report from the auditors, you'll see management's letter, and then you'll see all the notes of financial statements, because financial statements are not complete without the notes telling you what's going on. Okay, so let's do this week the Chapter 10 homework. Okay. Okay, so we're going to start with the homework problem today. So, short exercise 10.8. What they're giving us in this exercise is the stockholders' equity section of a corporation. So we're told how much common stock is, how much additional paid-in capital is, retained earnings, treasury stock, so we get total stockholders' equity. Okay, and treasury stock is subtracted because it reduces stockholders' equity. It's a contra stockholders' equity account. So during the next year, the company purchased treasury stock at a cost of $34 million and resold treasury stock for $15 million, and it tells us the treasury stock they resold had cost them $6 million. So we're supposed to record the purchase and resale of the treasury stock. Okay, so first up, they purchased treasury stock at a cost of $34 million. When we purchase treasury stock, we're going to be debiting treasury stock and crediting cash. Okay? And treasury stock, a contra stockholders' equity account, that's reducing stockholders' equity. We cannot own ourselves. So when we purchase treasury stock, we're going to debit treasury stock, credit cash. Okay, so that's the purchase of treasury stock. We're always going to debit treasury stock, credit cash. You need this journal entry written down because we're going to have a question on it coming up. So you want to make sure you're prepared for this question that's coming up. When we buy treasury stock, what's happening is we are reducing stockholders' equity. This first entry in the journal entry here, okay, treasury stock here, that reduces stockholders' equity. So we're reducing stockholders' equity, and then the second entry here, the cash credit, is reducing assets. So when we purchase treasury stock, we are reducing assets and we're reducing stockholders' equity. Both of those things are happening. When we purchase treasury stock, reducing stockholders' equity and reducing total assets. Reducing total assets, reducing stockholders' equity. Guaranteed you're going to need that statement in about 30 seconds or a couple minutes. Okay? So when we purchase treasury stock, it reduces total assets, reduces stockholders' equity. Okay, next up in this problem, we resold the treasury stock for $15 million, and it tells us in the problem that this treasury stock had cost them $6 million. Okay, so we're reselling it for $15 million. First thing I know, if I'm selling treasury stock, someone's giving me cash. So I'm getting cash of $15 million. So cash is going to be debited. Okay, we're getting cash of $15 million. I want to reduce my treasury stock by its cost. So when you see this credit here to treasury stock, the treasury stock, when we sell treasury stock, this is something new. We had not done it on Monday. That will be the cost. Okay, so this cost, the original cost is $6 million. That's what we reduce treasury stock by. Okay, so that's where that $6 million is coming from. And then the paid-in capital account, you can just write in paid-in capital. Paid-in capital for treasury stock transactions, that's the difference. That's the difference between what the treasury stock cost us and what we got for it. When we have treasury stock transactions, we never have gains and losses on our own transactions. Yes? Okay, the question is about separate transactions. During the first sentence, during the year, they purchased treasury stock at $34 million. Okay, so that's how their purchase is a treasury stock. The second sentence, they sold some treasury stock for $15 million. Yeah, and that's why they're telling you that treasury stock, it cost $6 million. Yeah. Okay. So what we're doing, we never, ever, ever have gains and losses on treasury stock. Because if companies were allowed to have gains and losses on treasury stock, they could do all kinds of fictitious things, things that don't have any meaning. So you can't have gains and losses on treasury stock. So we have this cash. Okay, no, you do not. I'm answering that one. Okay, in a journal entry, I don't care what journal entry we're doing, we never have parentheses. Journal entries are either debits or credits. The debits are in the left column, the credits are in the right column. Okay? Where you see the parentheses on treasury stock is where you put it in the balance sheet with the stockholders' equity. So you have all the stockholders' equity accounts, and then treasury stock will have parentheses around it. So good question, but in a journal entry, absolute positive rule is you're never going to see parentheses around a number in a journal entry itself. Okay. Okay, so we've recorded the purchase and the resale. Okay, so next, overall, it asks us how much stockholders' equity did it increase or decrease as a result of the two transactions. So we purchased $34 million. So I put brackets around it to show it would decrease stockholders' equity. We sold it for $15. Okay, we sold not that. We sold some for $15, giving us an overall decrease in stockholders' equity of $19. Okay, so the answer is stockholders' equity decreased by $19. Okay, now I have a couple, probably three, true-false questions coming up related to treasury stock. Okay, the purchase of treasury stock by a corporation increases total assets and stockholders' equity. True or false? Okay, purchase of treasury stock by a corporation increases total assets and stockholders' equity. True or false? This is going to close in about 10 seconds, so make sure you get your answer in. I still feel we should have the Jeopardy music queued up. Okay. Ready? Okay. Okay, that is false. Like we said, that when we buy treasury stock, it reduces total assets because we're paying cash, and it reduces stockholders' equity. Okay. Another one coming now. The purchase of treasury stock has the same effect as issuing stock. So think about when we issue stock to outsiders, is that the same effect on assets and on stockholders' equity as buying treasury stock? Are those two things identical? Same effect. Thank you. Another 10 seconds or so on this one. Let me look over your shoulder and see how we're doing on this one. Okay, on this one, think about, we just said on the last one, because right now about 22% of you are incorrect. So on this one, when we purchase treasury stock, we just said when we buy treasury stock, we're paying cash, right? So just think about cash. Just think about, so when we buy treasury stock, we know cash goes down. We're asking, is that exactly the same effect as issuing stock? What happens when I issue stock? When I issue stock, I'm giving an investor stock, and think about what's happening to cash of the corporation. Another 5 seconds or so. Now we have 32% people wrong. Okay, so my explanation worked not well at all. Okay, so let's try again. I'm going to pick on you. Okay, yes, okay. So let's just go through this. So when I buy treasury stock, what happens to cash? Cash goes down. So total assets go down, right? We're good on that? If I issue stock, what happens to cash? Goes up, right? So total assets would go up. And the question is asking, does the purchase of treasury stock has the same effect as issuing stock? Tell me it got better. Much better? Okay, okay. So we're going to close it now. Okay. Okay, and that is false. The opposite of purchasing treasury stock. Okay. That's what we're trying for. And then we have one more. Treasury stock, everyone should get this one right, is a contra stockholders equity account. True or false? Oh, close. Whenever you see the word contra, like some kind of contra account, it means it's opposite of the rest of those types of accounts. Okay, another 10 seconds or so. How are we on this one? 94% correct, so most, 93%. Okay, I'll quit talking. Okay, it's getting... Are we good on this? Okay. And that is true. Treasury stock is a contra stockholders equity account. It reduces stockholders' equity. Okay, next up, new topic. Talking about retained earnings, dividends, and stock splits. Okay, so this is kind of across the board. We said that retained earnings is this running total of all our income to date, less any losses, less any dividends declared. So retained earnings is just this running total from the beginning of our company to date. So all our income to date, less all our losses to date, all our dividends declared. So in this learning objective, what we're going to be doing is we're going to be looking at dividends, what happens when a company has a dividend, what happens when a company does a stock split, and some other miscellaneous topics. Okay, so dividends can be one of three types. We can have a cash dividend. A cash dividend is the most common dividend. Companies will issue a cash dividend. We can also have a stock dividend. A stock dividend, a company would say, everyone that has stock, we're going to give you a 10% stock dividend, so you feel like you're getting something, but all the company's doing is giving everybody 10% more, so it doesn't change anything, you just feel like you have more. And then a company can also give a non-cash asset dividend. So a company, and these are rare, but a company could, let's say, this is this is strange, but it could happen. If you had stock in, say, Hershey chocolate, they could give you a dividend in M&Ms. You know, you could get a couple pounds of M&Ms as a dividend. I'm still Easter candied out here. So anyways, so the most common by far is cash. You will not have to do any non-cash asset dividend. You'll have to be aware of what a stock dividend is. A stock dividend is just a company saying, oh, instead of, we don't have enough, basically companies say, we don't have enough cash right now to pay a dividend, so we want to make our shareholders feel like they're getting something. So everyone will get a 10% stock dividend, which means if you have 10 shares of stock, they're going to give you one more share of stock. You don't really get anything because everybody's getting 10% more. So it's just like taking a pie that's 10 pieces and now we cut it into 11 pieces. The pie is exactly the same, it's just reallocated with more shares. So a stock dividend is kind of almost like a shell game, but it's not illegal. It's certainly not a con or anything. It's just the market price. If a company issues a stock dividend, a lot of times the market price of stock will go down to reflect that there's more shares. Okay, so cash dividends are where we're going to focus. There are 3 relevant dates with a cash dividend. Okay, so the first date is the declaration date. A dividend does not exist. A dividend is not a liability until the board of directors declares it. I don't care if if you've paid dividends every single quarter for 100 years, you do not have a legal obligation to pay a dividend in any quarter, any year, unless your board of directors declares it. There's also a date of record. A date of record is where the board of directors says, okay, we're declaring a dividend as of whatever date, this date of record, and that means everyone that owns the stock on that date will be entitled to the dividend. And then there's a dividend payment date, because the date they declare it, they say, well, we're going to pay it as of this date, and then the payment date, the check date, will actually be a couple weeks later. So you have 3 dates. There is no entry on the date of record. That's just a bookkeeping thing. It's just a, if you own the stock on that day, you get the dividend. Stock prices reflect this. The market knows this. So the last day, the date of record for a dividend, the stock price will be a little higher because anyone owning the stock on that day will get the dividend, whereas the next day, it no longer, if you buy it the next day, you don't get the dividend. The owner on the date of record gets it. So the declaration date and the payment date are the 2 dates that count in terms of recording entries. So let me show you a recent example. Dunkin' Donuts. Okay. Dunkin' Donuts declared a dividend of 0.265, so 26.5 cents on February 5th, 2015. So February 5th this year, their board of directors met, and the board of directors said, we are going to pay 26.5 cents for every share of dividend of Dunkin' Donuts stock that people have. Now that may not seem like a lot, but it's a lot. It's also a 15% increase over their last dividend. So that's a signal to the stock market and investors that Dunkin' Donuts is doing well because they are now returning more to investors than they were before, and this is a bump up of 15%. Okay, so the date of declaration is February 5th. To be paid on March 18th. To be paid on March 18th is the payment date, okay? And shareholders of record as of the close of business on March 9th. So March 9th is the date of record, okay? So if you own it March 9th, if you owned it March 9th, you get the dividend. Now, on February 5th, Dunkin' Donuts has a liability for those dividends. February 4th, no, because that dividend liability does not exist until February 5th. So February 5th, Dunkin' Donuts now has a liability for dividends. It has to pay it. It now has a legal liability. On March 18th, Dunkin' paid the donuts, paid the dividend, so that liability would be gone on March 18th. Okay, so there's an example of a real dividend. Dividend policy is quite complicated. There is no one policy that fits all companies. Some companies, typically, utility stocks. So say First Energy. First Energy is not an exciting company. Not to insult First Energy, but it is an electric company, so it's not high tech or high growth. It's pretty steady. So First Energy typically pays a dividend and pays a healthy dividend. And investors that invest in First Energy and other utility companies pretty much expect a steady, healthy dividend because they're investing for income, okay? Other investors may be looking to invest for growth. Well, if you're looking to invest for growth, you're probably not going to invest in a company like First Energy because First Energy has a lot of mandates that they have to reduce electricity use, etc. So when you're looking for a growth stock, you're probably looking for more of the startup companies. And startup companies don't have a lot of cash, so they won't pay dividends typically, or they pay very small dividends. So dividend policy is very unique to each company. There's some rules of thumb you can look at in various industries, but there's no answer for why companies, one answer for why companies pay a dividend and why they don't. Okay, so some examples here. When we declare a dividend, what's happening when we declare a dividend, you need to know the journal entries on the 2 dates and what happens on those 2 dates. So the date of declaration. So we have this example, June 19th, the Board of Directors declares a $50,000 cash dividend. So on the date of declaration, the entry will be to reduce retained earnings. We're going to debit retained earnings, and we're going to credit dividends payable, that liability. The date we declare it, we have a liability, and we're reducing retained earnings. Okay? So what's happening there is we're increasing liabilities, decreasing stockholders' equity. Okay, we have a question coming up in a minute or two on this very item here. So this bottom part, this is going to be in the question that's coming up in a minute. My question is going to relate to the effect of declaring a dividend on liabilities and stockholders' equity. So liabilities, when we declare a dividend, liabilities go up, stockholders' equity goes down, okay, on the date of declaration. Again, I have a question coming up that asks you on the date of declaration, what happens to liabilities and stockholders' equity? Date of declaration, we're increasing liabilities, we're decreasing stockholders' equity. Okay, so we have the declaration date. There are 2 important dates from an accounting standpoint. This is one of them, declaration date. Declaration date, we're reducing retained earnings and increasing dividends payable or liabilities. Okay, so the next date that matters here is the payment date. On the payment date, when we actually pay the dividend, what's going to be happening there is we're going to reduce the liability, so dividends payable will be debited and cash will be credited because we're actually spending the money. Okay, so on the date of payment, we will be reducing, we're reducing our liabilities, we're also reducing assets. On the date of declaration, this is the payment date, the liability is created on the declaration date. We do not owe anything until we declare it, till the Board of Directors declares it. Once the Board of Directors declares a dividend, it is a legal obligation. Again, you could have paid dividends for 100 years right in a row. If your board of directors does not declare a dividend this year, you don't owe it. You don't have a legal obligation. You never have a legal obligation to pay a dividend until it's declared. Okay, we're going to have a couple of questions here. So the first one, the effect of the declaration of a cash dividend is to what? Increase liabilities, decrease stockholders' equity, etc. So take a look at those answers. We went over that one. What happens when you declare a cash dividend? Okay, the effect of the declaration of a cash dividend. Effect of a declaration of a cash dividend. We're going to close this in about 10 seconds. Again, you can look back in your notes just a minute or two ago. We talked about this. Pretty good on the answers, number of. Okay. Okay. And the effect of the declaration of cash dividend is increasing liabilities, decreasing stockholders' equity. We're doing that debit to retained earnings, which reduces retained earnings or stockholders' equity, crediting dividends payable, which increases liabilities. Okay, one more question here. The date when a cash dividend becomes a legal obligation is on the what? Date of record, declaration date, last day of the corporate year, or payment date. Which one of those? Okay, so the date when a cash dividend becomes a legal obligation. This is saying, when does it become a liability? Another 10 seconds and we're going to close this one. Okay, it's the declaration date. Okay, the reason the payment date is not right is the payment date is the date that we pay it. The day we pay it, it's no longer a liability because we paid it off. So when the board of directors declares a dividend, that's when it becomes a legal obligation or a liability. Okay, we're going to say a little bit more about dividends and then we'll go forward. We already talked about stock dividends. Let's go to stock splits. Okay, so a stock dividend is where a company says, we're going to give you 10% more stock or something like that. A stock split is something a little bit different. This is where we say, let's split our stock in half. Let's do a 2-for-1 stock split, where we're just going to take our stock and double the number of shares that are outstanding. When we have a stock split, there is no accounting involved. When we have a stock split, so if a company has 10,000 shares, if they do a 2-for-1 stock split, everybody will get twice as many shares. Companies do this to reduce their market price of their stock. Now, I'm going to give you an example because stock splits, we don't have any accounting entry. If we have 100 shares outstanding and we do a 2-for-1 stock split, we're going to have 200 shares outstanding. So I'm going to go through a little example about why a company would do this. Okay, Apple. Apple did a 7-for-1 stock split, which is almost unheard of, in June 2014. Before the split, their stock was valued at roughly $650 a share. After the stock split, so everyone that had 1 share of Apple stock now had 7. The market price of the stock was roughly $94 a share. The reason Apple did this is they felt with their share price hovering around $650, it really limited the number of people who would buy their stock, because that's a big price tag for one share of stock. So Apple said, we're going to split 7 times. So if you have 1 share of stock in Apple, after the stock split, you're going to have 7 shares. So what happens to the market price, the 650 basically roughly gets divided by 7, so you get your stock price down. The reason Apple wanted to do this, it's rumored, they didn't come out and say exactly why they wanted to do this, but they wanted to be included in the S&P 500, the index that you always look at, where you hear about the stock market, how it's doing. Well, that's composed of 500 companies, and they don't typically put companies in there that have a really big stock price. So the rumor has it that Apple wanted to be, they want to be a trendsetter, right? They want to be in that group. So they did the stock split, and they were recently added to it. So they became part of it. So that was the rumor about why they wanted to do it. But the stock price just gets huge, it gets unwieldy, and just going back to Apple, just so you know, Apple stock splits over time. 1976, let's say you had 1 share of Apple stock. Apple has done stock splits over time. So in 1987, they did a 2-for-1 stock split. So if you had 1 share back in 1976, in 1987, you would then have 2 shares because they did a 2-for-1 split. And then in 2000, they did a 4-for-1, or they did a 2-for-1 stock split again. So for the 2 shares you now had, now you have 4 shares. Okay, and then in 2005, Apple did another 2-for-1 stock split. So now your 1 share from 1976 is now 8 shares in 2005. So then in 2014, Apple did a 7-for-1 stock split, which is really, really unusual. 7-for-1 stock split, you now have 56 shares. So your 1 share back in 1976 would now be 56 shares because of the stock splits Apple has done. Now, a stock split doesn't have an accounting entry. It's simply saying, boy, you had 2 shares before, now you have 4. You're just going to do, it doesn't impact the accounting per se. Yes? No, because the stock price back here, let me go back here. Yeah, like it was 650 before the 7-for-1 split, and then it fell to 94 after the split. Yeah, I mean there's some momentum going from there, so you might see a little positive bump. Yeah, but it's going to go. I mean, it went from 650 down to 94, so it wasn't like, oh, look, I got 650 times 7. But yeah, they do it to make it more easily traded at a lower price. There's some idea. There's some theory behind what the optimal stock price is for marketability. Sometimes they debunk that, sometimes they don't. But Apple wanted to be in the S&P 500, so and they got there in the index. Okay. Okay. So question, Lauren Cowlick's question: total stockholders' equity remains the same before and after a stock split. See how we're doing on this one. Okay, the answer for this one, I'm going to tell you the answer. You have one opportunity to hear it before I close the question. The answer for this is true, okay? So it is true. You want to make sure you've answered true. I'm going to be closing this question in about 10 seconds, so you keep the time, Haley, okay? Total stockholders' equity remains the same before and after a stock split. That is true. Okay. Okay. So now we're leaving stock splits and moving on. I think I have a homework problem coming up here. Before we get to the homework problem, I just wanted to point out something in your text that I think is good. Exhibit 10-7. Exhibit 10-7 is a nice summary of the impact on the different stockholders' equity on the accounting equation from different transactions. So that is a really nice one. If I were studying this, this is something that you could actually put each of those lines on an index card if you're doing flashcards, if that appeals to you, if that's one of the ways you study. Each of these lines could be a flashcard. But these are good things to know that if we purchase treasury stock, it decreases assets and decreases stockholders' equity. You can certainly reason your way through, but you want to make sure you know the content on this page. Okay, so that was just a hint that Exhibit 10-7 is good material to know. Okay, so we're going to go on to a homework problem. Homework problem 10-10. We're looking at accounting for cash dividends. So Glenside Corporation earned net income of $97,000 during the year ended December 31st. On December 15th, Glenside declared the cash dividend on its 6% preferred stock and 14 cents per share cash dividend on common stock. So what's neat about this exercise is we're going to see the difference between a preferred dividend and a common stock dividend, because they are different. When we have a 6% preferred stock, what that's telling us, we'll see the calculations in a minute, but the 6% preferred stock, what that means is the dividend is going to be 6% of the par value of $200,000. So that's going to be the dividend on the preferred stock. The dividend on the common stock, 14 cents a share times the number of shares. So that's important to know, that the calculation of a preferred stock dividend is a percent of its par value. The calculation of a common stock dividend is the amount per share times the number of shares. So they're calculated slightly different. Okay, so we need to write journal entries for declaring the dividends and paying the dividends. Okay, so on the date of declaration, so we're going to tackle the declaring the cash dividends first. Declaring the cash dividends. So when we declare the cash dividends, that's the date this becomes a liability. They have a legal obligation. So what they're going to be doing is they're going to be debiting the retained earnings and crediting dividends payable. They have to calculate the amount of the dividend. The amount of the dividend for preferred stock is going to be 6% times $200,000 par value. The amount of the dividend for the common stock is going to be 14 cents a share times 36,000 shares. I'm going to put it in one journal entry, so we'll see that right now. Okay, so the 200,000 times 6%, that is, okay, that's our preferred dividend. So the 6% times the par value of 200,000, those two, that is where we're getting the preferred stock dividend, which is the first part of this. The common stock dividend is 14 cents a share times 36,000 shares. That's where we're getting the second part. So our combined dividend is $17,040. So when we declare a dividend, we're always going to debit retained earnings, credit dividends payable for the amount of the dividend. And this one's just a little twist because we've got a preferred dividend in there and we've got a common dividend in there. Okay, so on the date of declaration, we're going to debit retained earnings, credit dividends payable. The second entry here, paying the cash dividends on January 4th. So we declared them in December. Now January 4th comes along, and we're going to pay them. So when we pay them, we're simply going to debit the liability, credit cash. The $17,040 was the amount of the dividend, the preferred dividend plus the common dividend. Okay, now we're almost done with the problem, but the last part of the problem is an easy one to get tripped up on because there's one part of it that's easy to forget. So the last part says, did retained earnings increase or decrease during 2014? So what I've done on the screen is both our journal entries are showing. So those are the two journal entries we just went through for A and B. A, we debited retained earnings and credited dividends payable. B, we debited dividends payable and credit cash. So the last sentence of this problem says, did retained earnings increase or decrease during 2014? Okay, now, so there's one obvious part of this in here. It's what happened to retained earnings. But retained earnings, let's go back, let's go more basic here. Retained earnings is a running total of all our earnings to date less any dividends declared. So all our earnings to date, if we read the problem, well, let's go with, first of all, retained earnings is debited on December 15th. A debit to retained earnings will reduce it. Retained earnings has a normal credit balance. A debit balance reduces it. So we have a decrease to retained earnings of $17,040. But we're not done. Retained earnings is also impacted by net income. And back at the very top of the problem, up there at the top, where it says income of $97,000, that would have increased retained earnings. So what we end up with is net income's $97,000, that would have increased retained earnings. Dividends declared of $17,040 would have decreased it, so our net increase in retained earnings is $79,960. So when you're doing the homework, don't forget about the net income, because you just get done with the journal entries and you want to just take that retained earnings debit and that's your answer, but it's not. You've got retained earnings is a combination of two things. Earnings, net income to date, less dividends declared. Retained earnings has a normal credit balance, right? Because retained earnings, all your earnings to date would be a normal credit balance. Got this question out here because I want to talk about retained earnings. Retained earnings, a debit balance of retained earnings indicates that a company's lifetime earnings exceeded its lifetime losses and dividends issued. And I'm going to give you the answer right now because I want to talk about it. So this is out in Learning Catalytics right now. The answer is false, and I want to talk about why. The normal balance for retained earnings is a credit balance. Net income is a credit in retained earnings. So retained earnings is this running total of all our income to date, less the dividends declared, less any losses. The only way you have a debit balance of retained earnings is if you've had losses and dividends that exceed your earnings to date. So this one is false. Okay? So know that retained earnings has a normal credit balance. If you have a debit balance in it, you've been losing. You've had some losses and some combined with dividends. Okay, we good on that? Okay, we're closing this question in 10 seconds. I gave you the answer. Submit it. You're running out of time here. I'm going to go on, but close it in 10 seconds, okay? Okay, Learning Objective 5. This is a good item to read once and move on. And then we have stockholders' equity section in the financial statement. So what I want to do for this one is go through a homework problem. Rather than lecturing on it, I want to go through a homework problem, and then we'll see how this is reported. Exercise 1018. 1018 is a statement of stockholders' equity. Early in the semester, we had the statement of retained earnings, which basically started with last period's retained earnings, added our net income, subtracted dividends declared, and came up with ending retained earnings, and that's what we use. Well, the statement is actually the statement of stockholders' equity. It includes retained earnings, but it also includes the other stockholders' equity accounts too. So basically what companies do is they say, we have common stock, we have additional paid-in capital, we have retained earnings, we have treasury stock. We have all these accounts in stockholders' equity. They're going to go through and tell us what happened. So in this particular exercise, they give us a statement of stockholders' equity. So when you do this exercise in My Accounting Lab, you will get a statement of stockholders' equity. So you don't have to prepare one, but you need to be able to interpret the information on it. So what we're going to do now is we're going to walk through this exercise. So the exercise, we're going to come back to that statement. It says how much cash did the issuance of common stock bring during the year, what's the effect of stock dividends, etc. So we have a lot of questions to answer using that statement. Okay, so what I've done here is I have the statement and the question is at the bottom. Okay, so the question 1, how much cash did the issuance of common stock bring in during 2014? So when we look at the statement of stockholders' equity, the first line, row 3, this is in a spreadsheet, okay? So row 3 tells us the beginning balances. So going down to row 4, it says issuance of stock. So it says common stock has $320,000 in it. Additional paid-in capital has $1,190,000. When we record stock, the par value goes in common stock. Anything above that, the difference between the par value and the market price goes in additional paid-in stock. So the answer for this is those two numbers added together, the $1,510,000. So the line in the statement that says issuance of stock will give you the answer to how much cash did the issuance of common stock bring in. Okay, so you just look in the statement for that line. The statement's pretty easy to understand, and that's why we're doing this way. So you don't have to prepare one, you have to be able to read one. Okay, next question. What was the effect of stock dividends on Osborne's retained earnings, on total paid-in capital, on total stockholders' equity, okay, so on total assets? Okay, so what we see here is on the statement, it tells us that retained earnings were decreased. So you go across, we have common stock increased $42,000, additional paid-in capital increased $62,000, retained earnings decreased by $104,000. The net effect on total stockholders' equity is 0. So back, the far right column gives us the total stockholders' equity. So this decreased retained earnings, but you're answering some other questions there too. A stock dividend has 0 impact on stockholders' equity as a total. It has 0 impact on total assets. So that is there. So then the next question down, what was the effect on the stock dividends on Osborne's total pay? Okay, so I have 3 screens on this. On total paid-in capital, it increased the total paid-in capital. So again, for every one of these questions, you're just going to the line of the statement that applies for. And then total stockholders' equity has no effect on stockholders' equity, and on total assets, no effect on total assets. So we get that from that statement line. Okay, what was the cost of the treasury stock that Osborne purchased during 2014? So row 8 on the statement says purchase of treasury stock. So these statements are set up to tell you exactly what's going on. So purchase of treasury stock has a reduction of $13,000. That's the cost of the treasury stock purchased. Now, the next one, what was the cost of the treasury stock that Osborne sold during the year? So the next question, the next row down says sale of treasury stock. Again, the questions are set up pretty much in the order in which this statement is presented. And then it says, for how much did Osborne sell the treasury stock? The total amount of the sale is going to be the paid-in capital and the treasury stock number added together. Okay, we have a couple more questions that are asked on this statement. Question 4, how much was their net income? Row 5, you can find the net income on the statement. It'll tell you net income, and there it's given. Okay, Osborne revalued in an unrealized gain. Okay, this one, this is the one that is the least obvious of all the questions. It's asking us how much comprehensive income is. Comprehensive income, to get that, should be your net income, which I've circled, plus in the question 5, it tells you in question 5, it tells you that you have a gain here, an unrealized gain of $9,000, a currency transaction gain of $10,000, and then net income of $76,000. So those three things together I'm going to go back and answer that one, so just let that one go. Okay. Okay, so this is one of those trust me ones. When you want to get comprehensive income, you're going to add net income and the unrealized gain in the currency translation. I will not ask you a question that asks you to calculate comprehensive income on an exam or on a quiz. This is just for this homework problem. Know that you have to add the two numbers given in part 5 to the net income, and you're good. Okay. Okay. And I want to go back. There's a question in the chat room about why does issuing a stock dividend increase paid-in capital and common stock? I did not go through the accounting for a stock dividend. A stock dividend doesn't impact us necessarily. I don't want to get into the exact accounting for a stock dividend because it's kind of beyond what we're doing. But when we're interpreting, okay, so question, was that stock dividend question 2? Okay. When we're answering question 2, we just can use that line, the line that's given. It's when there's a stock dividend given, when you give out a stock dividend, you have to do an entry that reallocates from paid-in capital to common stock for the par value. Again, I don't want to get into that, but in this question, you can answer it by looking at the stock dividend line on the statement. So you don't have to do the journal entries. It just reallocates things within the stockholders' equity section itself. So we're not going to do that entry per se, but we can at least interpret what we're given on the statement. Okay. Let me get back to question 5. How much should be added to Osborne's accumulated other comprehensive income? That would be $19,000. That would be that unrealized gain they're giving us of $9,000 and the currency translation gain of $10,000 they're giving us right there. We just add them together. Again, this question 5, if I were writing this exercise, I would have left question 5 out, but I like the rest of it, so that's why we're stuck with question 5. It's not too bad if you just do what it says, but I'm not going to ask you other questions related to question 5. It's the other ones that I wanted to point out. The 19 is in the question itself. This is, the question itself said we had those two. Okay. Yeah. Okay. So, another question. If a corporation declares a cash dividend, so go back in your notes to the declaring a dividend. So when we declare a dividend, the date of declaration, what are we going to be debiting? So this is just simply looking back at the journal entry for declaring a dividend. When we declare a dividend, what gets debited? Remember, a dividend, when we declare it, is when the liability, when it becomes a legal obligation, when a liability is created. But we're looking for the debit. That's very, because the journal entry has a debit and a credit. Right now I'm seeing a lot of people that are choosing the credit side of this. So go back and look at the journal entry for declaring a dividend. Okay, but 10 more seconds on this one. When we declare a dividend, we're going to debit retained earnings and we're going to credit dividends payable. When we declare a dividend, it becomes a legal liability. So we're recognizing the liability. That's where a credit comes from. The debit is retained earnings. Okay, there's two entries you need to know with respect to dividends. The one is declaring the dividend, and the second one is paying a dividend. Okay, and then we have one more question for today. And a share of 5% preferred stock has a par value of $50 and a market value of $75. The owners of the preferred stock will receive a dividend of what? I won't give you the number answer, but I will tell you what you need. Right now, I'm going to tell you what you need to do to get this answer. To get this answer, you will have to take the 5% times the par value, okay? Market value is irrelevant when computing a dividend. The dividend on preferred stock will always be the percentage times the par value. Percentage times the par value, we've got a percentage of 5%, a par value of $50, okay? And that's how you'll calculate that. About 10 seconds left to submit your answer. Okay, and the answer will be $2.50 a share. Preferred dividend is always the percentage times the par value. And that brings us to the end of this chapter. So the homework for Chapter 10 is due this weekend on Saturday, and I will see you again on Monday.